So did you guys hear the most important tariff news of all?
No.
No.
Potential 200% tariff on French wine.
Well,
The true tragedy of the trade war.
I'm heartbroken.
And my favorite part of it was the tweet that said, "Well, now people will be able to enjoy amazing American wine and champagne." And I agree on wine, but I'm just going to be a snot and say there is no such thing as American champagne.
You can't call it champagne if it comes from that region.
There's American sparkling wine, but there's not American champagne.
Exactly.
Behind me,
Exactly.
it's out of the screen, but I have your bottle of Dom Perignon for you, Robert.
Even if you could call it champagne, is there a drinkable American champagne?
I've had some pretty good sparkling wines out of California. I think there is, but it's not champagne. Next time you come to New York, I got to give you this bottle. Although it does make on the wider shot, it does make my screen. I'm referring to a bet that Robert and
that wager was made 10 years ago. Yeah,
I know, and I forgot about it until we started doing the show.
Yep.
I bought this for you in May, but we haven't seen each other in real life, so anyway.
No, we'll have to get together. I'll have to come up to I haven't been in New York in 5 years at least.
What? That's crazy.
I'm not going to New York and missing people. I just haven't been up there. I think I've taken one flight a year for the last 4 years.
Well, I haven't been in Philly probably.
I've been a homebody.
Wow, it's been a while. But my husband's, sort of raring for a cheesesteak this summer, so.
Well, maybe you could take a day trip or come down for a night.
Exactly. Exactly. So maybe I'll deliver your champagne. How's Florida?
It's wonderful. Although
It looks sunny and warm.
my lease is up on Sunday, so I'll be back in Philly this weekend.
Got it. I think you missed the worst of the winter. I think.
Yep.
Knock on wood.
It looks like winter's over. Natural gas is going to reflect that soon, in my opinion.
Yep.
It might be $3 soon, $3.25, something like that, $3.50 at least. That's still a lot better than it was last year. It was $2 and change this time.
What are you watching this morning, Bakes?
Pardon me?
What are you watching this morning?
I'm watching Del Rossi's cheesesteak on 4th Street. I was there for the Super Bowl for an In-N-Out, and apparently it beats Pat and Gino's by a country mile, according to the locals. So go to Del Rossi's on 4th Street. Don't go to the 4th Street Deli unless you order half or a third of what you think you're going to eat. It is Katz-esque, in my opinion. So, other than that, stocks. Yeah, I'm kind of like a lot of us. Some things weren't working. Let's get rid of them, and let's find things that are. And so that's what I'm going to talk about. And frankly, I did a lot last night that I'll talk about in a future show that I'm putting the trades on right now. And let's rock and roll, shall we?
Okay, yeah, let's get started. So, welcome everybody to the Beats Roundtable. Today, I'm Berna Barche, and today is Thursday, March 13th. And with me today are Robert Marson and Kevin Baker. I'm going to kick it off by starting with Robert. What you got?
Hi. Well, yeah, let's do a couple of updates. We all know the apparel business is bad. We all think we know the shoe business is bad. But Skechers CFO presented at a conference yesterday, and he talked about their business, specifically all the regions. And the tone in his voice and his commentary suggested that the U.S. business was fine, perhaps, not great, but fine in the male sense of the word, not a female sense of the word. Because when a female says it's fine, it's not fine. But this was and, he said that there was a little less store traffic because of the uncertainty and the slowdown in consumer spending, but a pickup in DTC. So, probably online. That's what he meant. And then he went to say the rest of the world was still very strong. And he went region by region. Wow. Latin America or South America was strong. Europe was strong. Asia was strong. India was strong. Asia ex China. China is still in the dumps for them, probably down around 10% in their sales the last couple of quarters. So China's not great. So the stock's down. The stock's starting to get very cheap. And, if I weren't very concerned about more of a consumer recession than I am right now, I would probably buy some stock. But I think the downturn in apparel and footwear might just be starting. While these guys benefit from a trade down effect because their shoes are a lot cheaper, let's just say my commentary on Nike was to take the under from our talk when the stock had gotten up into the high 70s and 80s. I don't believe a lot of people are going to be spending $160 on Nikes. I think the stock is not reflecting a turnaround in the business, and I think the stock is expensive with bad fundamentals, and will stay that way with bad fundamentals. So Skechers at least sells $50 shoes and $60 shoes. So in a recession, they tend to pick up a little market share, I think. And I would, again, I'm not defending that idea here, but I do own it. I own it at a much lower basis. I've never sold it. So I would be I would be looking to buy it if it dropped a bunch more, or if we got a full-fledged recession and they pooped to bed on numbers like everyone else, and the stock got cheap and they reset expectations. But that would be for another quarter or two or year, and not for today's purchase. So
yeah, it's interesting. You and I talked about this one a few weeks ago on the show, and we both were like, okay, under $60. And now it's whatever it is, like 56 or so.
Yep.
I know that I personally updated all my alerts in my Bloomberg yesterday, and I changed my new alert on this one to under $50. Now, maybe that's being greedy, but it's just, I feel like there's, for lack of, no pun intended, a few shoes that may need to drop first before this thing's totally cleared. But I'm with you that I'm looking for the right price. I guess maybe what's changed between that conversation and now is that, I think it's pretty clear that we're in a full-fledged recession at this point, and we'll find out in 3 quarters when the government calls it. But that perspective changes my price target for entry. I don't know what's changed for you, if that's
I would agree that I would reiterate that. I totally agree with that commentary. So you definitely can't use the current estimates, which are mostly off of last year's good numbers for all these stocks. And in the same vein, I got stopped out of my my Abercrombie and Fitch position. I had a starter position. I had it in the high 70s averaged. And I got stopped out at 75. So they were supposed to be buying enough stock to prevent it from going down. So I had a tight stop loss on that starter position, and it got hit this morning. So I'm not trying to defend apparel and shoe stocks right now either. I own a modest position in Skechers that I've held for 5 years, and I've bought the dips in the past, but we haven't had a full-fledged recession in 5 years that I've had to buy. But in the past, these guys are investing very heavily for growth, so their expenses are going to be up double digits. And if they get a revenue shortfall, it could really play havoc with the income statement for a couple of quarters until they rebalance. So,
although a lot of that flex investing for them, a good part of that is probably marketing, which they can choose to pull back on. The question is, how nimble are they in reacting to the environment, and how hard are those commitments? But to the extent it's something like digital, then, they can pull back on that. Those have very short lead times.
Yeah, it's $700 million in CapEx, which is all double to triple what they normally do. So
it's not in OpEx?
Both OpEx and CapEx, yeah. So,
but isn't that OpEx marketing? No? It's
I said, but it's CapEx and OpEx both are aggressively up. Yes. So, and then we have a stock that I'm actually starting to buy
Can I
more of.
stay here for a second? Can I stay here for a second? Because I talked about the shoe stock. I talked about ANF negatively, put a sellout on it, and members can go back and look at that. And I didn't like the shoe stocks. I said shoe stocks stink. Crocs and Deckers and Skechers. And then this past week, which I think we brought up the Nike comment, on which was, I'm not going to say shoe to drop because it's too damn obvious, but this was supposedly had a good earnings report, and the market doesn't care and it's taken out this low. And my point being is, take a look at this pattern here when it takes out the 200 day to the downside and rolls. Come on, baby. It takes out the 200 day to the downside. He said, well, whatever. That's what this looks like right now. This is Nike in 2021. That's when it went through this. Numbers disappoint. The names I just mentioned, like On, started eating their lunch, and it's gone through this whole process into this base. The knife is on the floor. It's no longer falling. Now, could it take out the low? I suppose it could, but this is a base. And I'm not saying that they're taking share from the other shoe companies. I'm saying the stock is washed out. And so, am I buying it? No, because I want some other things to happen. But we've been talking about this, especially with Jeff Mackey, and Nike's gone through the process. It's spent 4 years being thrown out, and the darlings like On, don't buy On Semiconductor, are just starting this process. So that's my point with Nike. This is a base.
What are your thoughts on where Skechers might enter a viable area?
This is a falling knife. Okay, it's a sale here at the 200 day going down. I will answer the question, but my point is that this is early in the process of distribution, and the folks that rode this, and these have been great stocks. I mean, God bless them, especially over the last 5 years. But then you go to the longer term chart, and frankly, this is decent support where we are. Look at this. This goes back to 2021, okay, when Nike started to give up its lunch. And, would I buy it here? Not with the way that daily chart looks, but, that's pretty good support that goes back a lot of years. A lot of years. So, down here at, what's this? 46 to 56. So you're under 50, I think makes a lot of sense.
Got it.
So 45, 48 would look like 46 to 48 would seem to be washed out and cheap enough to take a shot at it. I would agree with something like that.
And that's this level right here, which
I would be short Nike if I had to be long or short, even if it's basing, because it's still 30 times earning with big negative sales reports. So
same.
No, here's the thing.
I don't believe that the stock chart knows everything. So
I don't think there is no knowing. There is no certainty. It doesn't exist. I don't pretend that in the least. Let's see what happens when these anticipated god awful reports come up, and let's see what the stock does. There's the business and there's the stock, and then that's how they converge. That's a base. And it looks like it's all those negatives that you've highlighted seem to be pretty well disseminated. We've had 4 years to disseminate them.
Yeah, well, we'll see. Apple had the same thing, and it went to 260 with bad news.
Well, that's one of my names.
Everybody said, why should Apple go up on bad news? Because it's shit fundamentals. And now the stock dropped 20% in a couple of weeks, So eventually the fundamentals catch up with valuation, and the stock reflects both, in my opinion.
Yeah, and I mean, I think the other thing that's holding up Nike is excitement about Elliott Hill and it's sort of a return to their roots. This goes to the fundamentals, but there's a fair amount of turnaround priced in there, and I think you have to step back. If you believe that we're in a recession, which I think I do, I know Robert does. I don't know about you, Bakes, But if you believe we're in a recession, you have to think about the fact, and I talked about this on Tuesday, that maybe 1 out of 4 retail turnarounds, maybe, or 1 out of 5 will work. And then you put a recession as your backdrop and it goes to 1 out of 10. Now, Nike is not every sort of retail apparel footwear kind of company. It will turn at some point. It is, in my mind, too big, too well known of a brand. It has too many things going for it not to turn eventually. But the timing of that turn, I don't think it's going to be during a recession. I think you have
I,
similar.
I want to bring up a couple of things. Number one, I'm not an economist. I don't play one on TV. Number two, recession was universally viewed at the end of 22, and it did not happen. And number three, and this is a big one, we all have to be ready for a day when Trump comes to the podium and said, mission accomplished, my tariffs have worked, fentanyl deaths are down, illegal crossings are down, I've got a new agreement with our friends to the north and south. Champagne is okay again. And if he says that, then all this recession stuff goes out the window in an afternoon. And I'm ready for that. Now, am I positioned perfectly? Probably not. But that's a real possibility.
I agreed with the first half of what you said. I think that if he comes out and he pulls back on tariffs, which I think is, I'm not sure that's going to happen because I think there are some true believers on tariffs here. But assuming he does give up the ghost on this tariff stuff, I believe we get a violent rip, a very, very violent rip up. Will it hold? Will it be the end of the economic problems? The difference between 2022 and now, in 2022, I was a buyer of all the big tech stocks, Netflix, Google, Meta, it was a great buying opportunity. The difference between then and now is employment. What gave me confidence in the fact we weren't in a recession was that unemployment was so low, and I was pretty confident it wasn't changing. We had sort of other things driving that sell-off. This time, it's what's driving the sell-off besides tariffs is a meaningful and abrupt slowdown in consumer confidence that we're seeing in actual business reports all over retail, travel, and everything else consumer discretionary. And what is driving that is people's fear about their jobs. And in the case of federal workers, which is 3 million people, very real reasons to be afraid of it. And it's not just 3 million people, it's more like 8 to 10 million people when you think about universities, government contractors, and nonprofits and everything else that's government adjacent. So whether it's, you think, some people think this is intentional to break inflation. Some people think it is, accidental, whatever it is. I think something shifted.
Berna, I'm going to point something out that I didn't see anybody write on, but last, when we had the employment report last week or 2 weeks ago on Friday, it was the corporate one, the enterprise one. The survey was fine, right? There was job growth of whatever. I forget the number, 150,000 or something. But the household survey showed an 800,000 person job loss and a 200,000 loss in swap jobs from full-time to part-time for economic reasons. So in the last jobs report, the household survey, not the establishment survey, showed 1 million full-time job losses in the month. And I didn't see a single economist on CNBC or Bloomberg or Twitter talk about that. And that's recession. That's a recessionary number. So the question is, who do you believe? The household survey, the establishment survey? Who has significant revisions that wipe away millions of jobs every year? The establishment survey. I believe the household survey more than the establishment survey. And the household survey just a week and a half ago said there's a recession starting with employment.
I would rather stick needles in my eyes than to read any of that because I mean, at the end of the day, how do you make money? And if I had it the day before, I don't think I could make money. It's like how headlines react. So I'm not an economist. Economists can't pick stocks, and so I'm just going to read charts and find bases like Nike.
I'm a stock picker and really not a top down person, but I respect the fact that the top down environment is going to really affect what my companies earn versus my current expectations, at least in cyclical sectors. So we'll see.
Now,
So
I do have a new upgrade to
yeah, let's hear about that.
table pounding. It's a name I've traded in the past, and I didn't sell much of it at the top, just a little bit. But Select Water, which is it's an oil service company, but its biggest and most profitable business is building pipelines to treat, recycle, and dispose of produced water in the oil patch in the U.S. And the only part of the U.S. oil service business that's growing is water production, and it grows 5, 6, 7% a year because the U.S. shale drillers are producing lower quality shale from their top tier, and part of that lower quality is less oil and more water. And a Pioneer CEO said the tier 1 acreage is all drilled out. We're moving into tier 2 and tier 3. That means the water cut should even increase from where it was. It used to be 4 barrels to 1 barrel of oil. Now it's between 5 and 6 and going up. So there is a growth business in the oil patch, even though drilling is declining at low to mid single digits. And that's half of this company's business. Now they have a competitor that does this for about 80% of their revenue, and the other 20% is tied to the same things that Select has, and they trade at 9 times cash flow, and Select trades at 4 times cash flow. And if you put up a chart with WTTR and ARIS together, and they traded pretty much very similar for the last couple of years until ARIS had really good earnings in the last few reports. The last report, Aris actually missed and guided down for the year, and yet the stock's at an all-time high for ARIS. That's just nuts to me, okay? But it's 9 times. So 80% water pipelines. So I have selected 50% water pipelines this year, or 60% next year. So I believe Select should trade at least half of the valuation that Aris trades at for its business that is directly comparable to Aris. So you blend the EBITDA multiples or cash flow multiples, you get a 7 multiple instead of the 4 that it's trading for now, and not the 9 that Aris trades for. So Select's at 4, it should be at 7. Aris is at 9. All the other midstream pipeline companies are 9, 10, 11, 12. And Aris was just catching up. They don't move natural gas, they don't move oil, they move water. Produced water is way bigger a growth business than natural gas or oil unit growth. So these growth funds that want access to the oil patch and have energy sector quotas, there's not a lot of growth. So they're paying anything for the 6 or 7 or 8% growth that is in Aris. They're paying 20 times earnings and 9 times cash flow. So, it makes it just a valuation spread for these two very similar businesses, especially as we evolve for the next year or two. And in the short run, the company has a lot of new business coming on, major projects that are very lucrative in the next 6 quarters. So there's going to be a massive explosion in their oil pipeline sales and profits. So I think that this company is going to do really well. They've taken about 6 quarters to get this pipeline system all networked properly and pointing in the right direction and signing large contracts. But I think the profits for that business are going to explode in the next 2 to 3 quarters.
You
I
buy
like
here?
we talked about it last year. And
Yeah,
it's back to where it was.
I bought it at 7 to 8 a year and a half ago, and I trimmed very little, 15% of it at 11 and change, but then it went to 15 and I didn't get any more off. And I'm looking to buy back the stock that I trimmed between 8 and 9 because I think there's decent support at 8 to 9.
Is there a line in the sand on nat gas prices? At which point like drilling would go down and, their growth numbers wouldn't come through?
Well, natural gas drilling is, a fraction of oil drilling rigs in this country right now. But with natural gas being $4, I think there will be drilling that'll resume. And there'll be associated gas coming out of the Permian from new wells, and they're gassier. So that'll be a little bit of growth. But the country needs the gas if the LNG development happens the way it's planned. And if there's needs for electricity growth for AI and data centers. So there will be, and it'll be anything north of $3. They'll drill for natural gas, which is a marginal profitable price for the shareholders. But the idiot CEOs of the natural gas drillers seem to think that their stated IRRs at the wellhead translate into shareholder value creation, but it doesn't. So they've over drilled for natural gas at 250 for a decade, in my opinion. So I would expect them to drill now $3 and above.
So we're sort of upon the shoulder season where it starts getting warm enough to not have your heat on, and but not warm enough to put your air conditioning on, which seems to be a time that gas takes a dip. If gas takes a dip, it's seasonal dip. Does this stock tend to follow that? Like, should we be looking for maybe a better opportunity in the next month as gas, maybe goes from 4 to to 350 or something? Or
This stock in the oil service sector has always been more tied to oil prices than natural gas because the rigs are a lot more for oil than gas. So I would say, I expect natural gas to drop into the low threes, mid threes, at least in the shoulder season, the next month or two. But if it doesn't, that's free money in my mind. But more importantly is whether oil holds 65, 66, 67. If oil drops below that and drops into the high 50s or 60, I think it'll be tough for the whole sector. Now, again, Aris is hitting all-time highs with oil going from 80 to 65. So there's still going to be growth in water production no matter what the price of oil is. Okay, and that's why I think Wall Street has fallen in love with Aris because they need growth. There's a lot of growth funds that they're making it their one energy play because it's still growing. So I think this company will grow no matter what with all the new business they have signed up. It's contractual, it's long-term, it's annuity-like, it's ridiculously profitable. And, I would think if oil went down 10%, this could go from 9.5 to 8 or 8.5 for sure. I think it's much more sensitive to oil price than the natural gas price.
Got it. Well, I liked this one before. I missed it. I'm now, I get a second crack at it. So thanks for updating us on this one. It's a really interesting idea. I'm going to switch over to Bakes now. Bakes, you told us that you were looking at what is working and isn't working. What do you want to tell us about today?
Yeah, we're transparent here, and we talk about what we do. And I did on Tuesday morning. I open up my statement, and anything that's a problem, I shoot. And I just don't want to have dead money around. And so this is what I did. This is a close below. This is Range Nuclear Renaissance, NUKZ. This is Cameco, the Canadian, and I know that's a swear word now, uranium producer, Constellation Energy, and I sold a third. It closed below the 200-day by not much, but I sold a third. I personally think that the AI data center trade was overblown. And I think that the China-India baked-in construction for nuclear plants is underappreciated. But this is what what the market has said. We need nuclear. We need it yesterday. It's going to happen, but I'm not going to lose a lot of money. I locked in a 7.6% profit here for my buy that I talked about when I first came on the show. I don't know, around here, I guess. And So I've got the 2/3 remaining. Don't know what I'm going to do with it yet. But I like nuclear long term, but I like my sell discipline forever because it keeps me from getting my thumbs sliced off. So that's gone. There's two other names that I'll talk about in the future because they're part of my trades that I'm putting on right now that I'm really changing the portfolio a lot. But this is my second stock that I shared internally. This is cloud computing, the Snowflakes and Twilios of the world, and it's just that it's not time for these stocks. It was down 15%, and I shot it. I didn't think about it. I didn't call the CFO. I didn't call the bull analyst or the bear analyst. I just shot it and raised cash. I went to 23% cash. And so it gives me all kinds of flexibility. And I just, I have a sell discipline. You may not like mine, but it works. And I know exactly what I'm going to do when certain things happen to cut losses and let my winners run. So cash goes up to 23%. My worst losses, only 2 losses, down 4 and down 7. So I'm not babysitting a bunch of chloroformed money over here that I have to try to exhume like Lazarus. And I know Lazarus wasn't exhumed, but you get the idea. And so that's just my portfolio moves for right now. We'll talk about new buys on the next show that I'm on. But just any questions about that? I just wanted to be upfront with people that these things didn't work, and I'm wrong, but I'm not wrong, but with a lot of money.
Also at about 25% cash here. How about you, Robert?
I'm only 21. I'm like the laggard here. But I sold stocks after they had run 100%, and I sold mostly winners, and some of them have turned into losers and blown up. And back to my cost, I've round tripped 3 of my 6 names, and 3 of them I took huge profits in. So I have where the fundamentals are still good. Like in select water, I don't mind pullback, especially if I tee it up for a much bigger purchase. I have no problem. I mean, I'd much rather have sold 100% and buy it all back at 40% discount for sure. But I could have done that to my 80% of my portfolio last fall when all those stocks were rocking, and Bakesy and I were looking and admiring the charts. So, and I agree with him on. When you do starter positions, if you take a 5 or 7% loss, to me that's a push. I don't even consider that a loss, Bakesy. That's a push. 5% gain or a 5% loss is a push in the stock. So that's
my point is I don't have anything that's down 15, 20, 25, 30, and most investors do. And then you the 80-20 rule kicks in, and you're spending 80% of your time trying to squint and get your the 20% of your losers to behave. And we've all been there. It's a miserable experience, and it's not productive. And I just like to clear the decks, and there's so many things to do. I got 4,500 ETFs. I need 10. I'm down to 9 ETFs, by the way. I've got one other stock I want to talk about, unless you want to go into this some more.
Let's have the other stock.
And I know this is, oh my God, Apple. Everybody knows Apple. Well, I put this in the context of, Meta's the only Mag 7 left. All the others are dead or wounded. Microsoft is gone. Tesla's wounded. Nvidia's wounded. And now Amazon is wounded, by the way. I didn't put it up here because I wanted to keep the charts down to a minimum. These things are rolling over. And it's just time. And this is not going to be a short-term situation because, portfolio managers have said, I've got to be market weight Apple, which is 7-8%, depending on the day. And now they're saying I got to get it to 3-4 so the Philadelphia pipe fitters don't yell at me too much. So Apple has finally joined the party to the downside. It took forever. The fundamentals are mediocre at best. The valuation is extended at best, and so now you get a bunch of people that anytime Apple rallies up to this 230 or so level, you're going to find a lot of sellers. And you can't find many people saying, I'm so excited about Siri or AI, I can't stand myself. So Apple, I've said Mag 7 is dead. I think it's, and big tech is largely dead. I'm sure there's some exceptions, but Meta is the one that's held up. Meta is the last one standing. And
Still
frankly,
down,
that one looks like
still down like 15% off the highs, though, maybe 10.
No, I get it. It was extended here. Look at this, 20 straight days going up. And we talked about the 700 level. That just there's no. Now we're at support. Now we're at the 200 a day. But I can't imagine there's a lot of people that haven't backed the truck up on Meta and now want to. And the volume is picking up slightly on the downside. I just think big cap tech is a bad place to be. And I'm waiting for Meta to make it official. So Amazon is broken, Apple's broken, all the others are broken. And I'm not bullish on Meta by any stretch of the imagination. I just say it's the last one that's probably going to go and make it official. So, there's big shifts going on, and I think most people feel it. But if people are holding on to things because they're great balance sheets and moats and cash on the balance sheet and all this, it's not going to help you. I don't think.
Agree. I actually coincidentally, I love Meta. It's my favorite Mag 7 stock. And, I bought most of my position in Nov 22, or Oct 22, whenever it was, fall 2022 when it was around 100. But I selectively added it to last year after the Q1 report in April when it dipped from like the maybe 500 level to the 430 level or something like that. That was the one time I bought since that sell off in 2022. I sold that stock yesterday, what I had bought in Q1. The slug that I bought at 100. It's kind of like Robert and the Skechers. I know it could go down. I'm comfortable holding it for a 5-year long term kind of hold. Because I believe the story long term, but I see it too. I mean, as much as I believe in it long term, the more likely move is down. And I didn't optimize that trade. I could have sold that 420 stock at 700, but I sold it at whatever it was yesterday, 630 or 640, whatever it was, and 620. I don't even remember. But I'm with you, and I sold it for the reasons that you're talking about.
Yeah, and by the way, I mean, there is no perfect. That's close to perfect, what you just described. And, for our members, you sell, if you can, you allocate to the higher basis, the most expensive stock you bought, so the tax bill is minimized. But then this is a six bagger over 3 years. I mean, that doesn't happen very often. And my whole point is that if people are in similar situations in any way, shape, or form, especially if they work at these companies, get ready to sell. If you can, you don't have 144 or political restrictions, don't ride these things back down. These can go down 50, 60, 70%. I'm not saying they're going to, but this is what stocks look like when they start to roll over.
Yeah. I mean, I just think there's a big, sort of rebalance. I mean, I spent all of yesterday rebalancing and, on my little micro level. But, there are people who run hundreds of billions of dollars who are out there rebalancing right now, making these kind of, decisions, that you're talking about. Like, especially the, people who are active managers who are managing to an index who have been overweight these things forever. Now they're saying maybe I want to be underweight these things. I mean, the big question mark is what are you rotating into, at least in the U.S. Outside of the U.S., as we've talked about, things are working. But not sure yet what people are rotating into, but they're certainly rotating out of these.
Not much. I mean, profitable biotechs, Gilead and Amgen, and not much else. I mean, it's...
I mean, I think I don't know about what Robert thinks. I think energy has been down so much that that's got to be a place that people are sniffing around. At least the brave
it
are.
didn't have a great year last year, but if oil prices continue to drop and Trump bullies OPEC into overproducing and it goes to 55, it won't be a great environment for oil stocks, even if they have some defensive characteristics. In a recession, commodity demand drops and the commodity prices drop, so they're not immune to a recession either, in my opinion.
Yeah. I mean, normally people would rotate into CPG here, but it's the perfect storm for them. I was talking about that in the chat. There's nothing really good happening on a sector level there too. It's hard to know where those dollars coming out of Mag 7 are going to go, but that's what we're trying to figure out. So well, if nobody has anything else, I'm gonna end it here. Thanks for joining us today. If you want more information, please check us out at wallstreetbeats.com, where we have reports and our exclusive chat for subscribers. And we'll be back tomorrow with more of our best ideas. Thanks so much.
Thanks, folks.
Thank you.